A winter's day in Perth afternoon. It's, I think, looking a little bit gloomy outside, but welcome regardless to NECA WA's COVID-19 super update. For those that don't know me, my name's Steve Scott. I'm the Fund Development Manager for Energy Super here in Perth. Before I welcome the speakers for this afternoon's event, I just would like to acknowledge and thank the efforts of NECA WA in getting this event up and running. Particular acknowledgement to Claire in advance and Aidan O'Grady. I know Aidan had wanted to be here to help run this session, but was called out urgently, so he gives his apologies. And I know Claire is working feverishly in the background. So thanks for your efforts in organising this. It's much appreciated. Today's session is twofold. We are going to cover off some of the economic and government regulatory impacts from COVID-19. And that session will be presented by our CEO, Robin Petru. So thank you, Robin, today. The second part will be what are the investment impacts and how are markets affected by the crisis we are all living through? And that will be presented by Kevin Wan-Lam, our Chief Investment Officer. So thank you for both of you and on your time today. The session is pretty simple. Please hold up any questions to the end. We will allow some time for questions, but the Zoom format doesn't really allow for questions as we go. So we will give some time for that. And I'll wrap up the session before we leave in about 45 minutes. So thank you, Robin. I'll hand over to you.
Thank you, Steve. Now, before we start, and because we are employees of financial services, I do need to give you the general advice warning. And just to let you know that the information we will supply with you today is general advice only, and we haven't taken into any consideration anybody's personal information. However, we are willing and capable of doing that, as we have a number of advisors that support us at Energy Super. Now, just on to the next slide, if you don't mind, Kevin. Kevin will be driving this, so I am in the hands of my CIO. So let's see how we go. Now, as you're aware, COVID-19 has been a word that's been on all of our lips for quite some time. And what's absolutely phenomenal is about the way that the government has responded to this. And if I look at it from an economics point of view and sort of leave out the personal view, because we're all sitting at home right now talking into our machines, the economic response to the coronavirus has been quite large, and they broke that down into three areas. One being support for businesses, and I'm sure that you are all very aware of some of the things, but I'll just run through those very quickly. Supporting the flow of credit and making sure that there was enough cash in the economy to be able to support the underlying issues and the support that the government's giving. And then, of course, supporting individuals and households, and obviously the impact that's been happening in the superannuation environment. And then I'm going to hand over to Kevin, and Kevin's going to really talk about the economics impact from an investment market point of view, and why we're seeing the irrational behaviour that's been going on in the marketplaces, and also what that means for all of us as investors. So if we just jump on to the next slide, support for business has been quite large. And Kevin, if you could just move on to the next slide, please.
Sure.
Thank you.
Cool.
There's been quite a number of areas that have gone into supporting businesses. So you've got boosting cash flow, and this is really about giving some cash to businesses who have annual turnovers of under 50 million. And for those who are well aware of this, there are two payments that are going to be made. One this quarter, and then one obviously in the next quarter, July to October 2020. And those payments will be directly related to salary and wages withheld, and that could be up to $50,000 for each payment. There's also a temporary relief for financially distressed businesses, and what that means is that there is an increase in the thresholds for creditors. So there's actually relief in paying your creditors, and there's an increase in the time to respond. There's actually relief for directors from any personal liabilities for trading while insolvent. And there's also relief from provisions of the Corporations Act to deal with unforeseen events arising out of coronavirus. And then, of course, the ATO themselves have also developed and tailoring solutions to meet that. There's an increasing in the instant asset write-off. So instead of the normal depreciation, there's actually the ability for you to increase the level of write-offs that are happening in your business. And then, of course, the depreciation of deductions, which allows you to deduct 50% of the cost almost immediately. So if you haven't been talking to your accountant, and for those who are in businesses, I would suggest that you do so soon, because all of these are now becoming available for you. There's also some areas about supporting apprentices and trainees. And so eligible employers can apply for a wage subsidy up to 50% for each of the apprentices. And those wages for 9 months from the 1st of January 2020. So that's a bit of a backdating up to the 30th of September 2020. And the offer is current or new employers up to $21,000 per eligible employee. And then, of course, the National Apprentice Employment Network is going to receive support to also coordinate redeployment for those who are displaced. And I'm sure that NECA has been sharing those news as well. And then there's the support for regions and communities. And so there's $1 billion set aside for regions significantly impacted during the outbreak. And then also airlines have also been given a certain amount of relief, although we noticed that Virgin's still under administration. And then across the top of that is the support for flow of credit. And this is really about 50% guarantee to small to medium enterprise lenders. There's going to be quick access to credit for small businesses. The RBA is releasing funding at a fixed rate of 0.25%. And then there is the support for non-ADI and smaller ADI lenders. So the support for the lenders themselves. And then supporting all of that, APRA has reduced banking capital ratios. And what that means is it allows banks to actually loan out more money than what they've previously been able to do. So that gives you a quick rundown of all of the things that are happening on the supporting of the businesses. If we move on to the next slide, please, Kevin. For individuals, there is obviously the income support and the JobKeeper scenario that we've all been talking about, but there's also individual support as far as government pensions and so forth. There's temporary early release, so that's happened mid-April, and we're seeing the drawdowns of people taking $10,000 out for those who are unemployed or have lost up to 20% of their income. At the moment, I think APRA's just released the numbers where we're almost tipping $1 million, I believe. Kevin, is that the right number? It's $1 million withdrawals and a couple of $1 billion, if I remember rightly.
Yeah, it's up to about $4 billion.
Yeah, so it's actually, and that's a week and a half in, so there's quite a lot of money that's flowing out of superannuation at the moment. There's also been a changes to the pension payments. For those who are in retirement phase, obviously capital impacts as a result of negative returns means that capital is a problem for people and pensioners. So the government has actually halved the pension payments, and so the minimums are now being halved, and that allows people to reduce the amount of money coming out of their superannuation. And then for those who are on social security, the deeming rates for pensioners has dropped by 0.75%. So there are more people who are now entitled to pension, to the age pension, than what they were before. So that's quite a lot of freeing up of money going into both individuals in retirement and pre-retirement as well. If you go on to the next slide, Kevin, I thought I'd bring that down to now what Energy Super is experiencing, some of the questions that are being asked of us, in particular relating to the things that I've just talked about. One of the things that slipped under the radar was a government regulation change that occurred on the 1st of April. And what that means is that there's now insurance cover that's been cancelled for a lot of under 25-year-olds. And we did spend a lot of time trying to communicate through this, but this now has actually come into play. And so insurance is no longer being provided to members automatically under the age of 25 going forward. We've been getting a lot of calls from members into our contact centre about income protection insurance. And a lot of people have thought that the income protection insurance was to do with the people who've lost income as a result of coronavirus or as a result of losing their job. I thought it was worthwhile just mentioning here that if you do get any feedback, income protection is medically related, so it's actually due to income not being received as a result of a medical issue. But what's really important though is that this cover is in place and will be so for 6 months, even when you're not actively employed. And there is coronavirus coverage, so there's been a lot of media about that. But if someone is sick, not just quarantined, for longer than the waiting period, they will be covered for that illness. The other thing that we're seeing a lot of is people worrying about whether they should switch or not. And this particularly impacts with early release and also with people who are receiving pensions or constant drawdowns. And one of the things that we have been talking to members about is making sure that before they do any sort of switching or any sort of movements within the marketplace, that they recognise that doing so will crystallise losses. And there's the time in the market, and it's really hard to time the market when it's so irrational. And I like to think that the toilet paper phenomenon that we're seeing in our lives today is often been playing out in the markets. And so you've seen some enormous moves up and down, and they are irrational moves. And so you can see the movement markets over March, where one day it dropped by about 17% and then turned around the next day quite dramatically. So there is some irrationality in there, and which means that people aren't going to be able to time the markets very, very well. Markets will be disrupted, and that is a fact. We have had conversations around the investment markets, and they do work in cycles. It is just knowing when those cycles start and finish that's always the challenge for all of us, and I'm sure that Kevin will talk a little bit more about that. So a lot of the conversations we've been having is talking about when you should be thinking about your investment options, and sometimes when the market's down or when the markets are up, crystallising losses or gains can actually be a hard-earned win. So what we have done is we've done a lot of articles, and we've put a lot of things on the website to help people understand how irrational markets have been, what they can do, and some of those things do include getting some over-the-phone advice and getting some of that information on a one-to-one basis. We have been talking to pensioners about ceasing payments so that they can actually make sure that their capitals do regain the losses that have occurred, and we've seen some of that happening throughout April. And we're also recommending that people should utilise all of our investment options and then to realign your risk profiles. And that can often happen without being switched at all. So there's a lot of things that you can do, and there are a lot of things that you do need to be wary of. But those are the sort of things that we have been talking to our members about. And I think I'll leave it there and hand over to Kevin, who will jump into the investment markets and what's happening in that space. So thank you, Kevin.
Thanks, Robin.
Over to you.
Let's see if I can drive this. So, in terms of what we're going to cover today, we're going to cover a little bit of an economic update, a market update. We're going to talk about the performance of Energy Super's investment options, what we're doing, and then right at the end, as Steve suggested, we'll take some questions. A lot of the things that Robin's talked about, I'll touch on as well, but just in a little bit more detail. So in terms of what's been happening to investment markets, this is very different to what we've seen previously. This is an exogenous shock. It hasn't been something that we've seen in our current lifetimes, and effectively it's a demand shock. So what we saw in March is we saw an extreme period of volatility as investors struggled to assess what was going on with COVID-19 and the impacts of it. In terms of government responses, Robin talked about some of the things at the granular level, but at a very high level, we've seen extraordinary amounts of money thrown at the economy, both in a fiscal sense, but also in a monetary policy sense by governments to try and dampen the impact of shutting down economies. In terms of some of the big responses on the monetary policy side, interest rates in the US were cut by 1.5%. They're currently 0. Here in Australia, and we had a Reserve Bank board meeting today where interest rates were held. They're currently 0.25%, and they were cut by 0.75%. So very low. Robin talked a little bit about funding and liquidity. The Reserve Bank of Australia are providing that liquidity to banks so they can lend to small and medium enterprises. They're also squashing interest rates at that 0.25% until they see some progress towards what they call full employment. And I would guess that's probably going to be somewhere between sort of 5 to 6% in terms of the unemployment rate. In terms of what's happening around the world, in the US, they've got $2 trillion that they are putting towards stimulating the economy whilst it's in shutdown. Australia's at 200 billion. To give you some context, for both the US and Australia, that's about 15% of GDP, or probably 2 months of what happens in the Australian economy. And then if we compare this back to that period between 2008 and 2010, Australia, its fiscal stimulus package at the time was about 67 billion, and in the US it was about 800 billion. So, significantly larger. In terms of what we're currently seeing, this is a little bit different to what we saw in that 2008-2010 period. There's a lot less debt, both within governments and corporates and households. We have a lot more cash. In terms of the cheap money part, this is good and bad. So the good part is that it allows businesses to get some access to cheap finance, but unfortunately, that cheap finance also allows some businesses to continue on longer than they should through a combination of the low interest rates and or some government assistance. The other big difference between that 2008-2010 period to now is that banks are very well capitalised. And during that period in the GFC, they were the problem. They were lending too much. They had lax capital controls. Now, sort of 10 to 12 years later, Australian banks in particular are very well capitalised. So they've got plenty of assets to back the loans that they've made. And the loans that they've made are actually mostly pretty good. They're not low quality as such. In terms of what else we're seeing, we've all seen petrol prices. Here in Queensland, they're around 80 cents for unleaded, and that reflects the fact that oil's gone from somewhere between $40 and $50 to below 20. The other thing worth noting is that both the Australian government, but also the Western Australian government, is in a very good position to provide further stimulus. And just talking a little bit about Western Australia at the moment, prior to COVID-19, the Western Australian government forecast budget surpluses between now and 2022 and 2023, and that was to the tune of about $10 billion. That means that the WA government is in a very good position to place further stimulus into the Western Australian economy, up above and beyond what the Australian government's going to do. So, that's a really good position to be in. In terms of the economic momentum in Western Australia recently, it was fairly positive in 2019, and that was driven by household consumption and a turnaround in business investment. So again, the fact that the economy was strengthening in 2019 should certainly help. The other thing that was growing during the last couple of years in Western Australia is population growth. It's currently at 1.1%, and that's the fastest population growth rate in the last 5 years. And then lastly, I've got a bullet point in here about Australia being a major trading partner of China, and it stands to be the beneficiary of any recovery. Well, that's obviously particularly very true for Western Australia, given the fact that, for example, 80% of all the iron ore goes to China. So we can reasonably expect that China will also have fiscal stimulus measures to help drive their economy, particularly within infrastructure and other forms of capital investment. But also, it's a two-way street, because Western Australia also has to import a lot of machinery and manufactured parts that are manufactured in China for domestic production. So I would imagine it's probably going to be a two-way street in terms of what happens in a recovery. In terms of how long this will last, look, we really don't know. And the other thing to note here is that what may happen in Australia will be certainly different to what happens in other parts of the world. We've seen Western Australia and South Australia, for example, have very few cases as in the Northern Territory, but on the other side of the country, in New South Wales and Victoria in particular, there are still cases on a daily basis. And then if you look around other parts of the world, the US is a very good example, as is the UK. It's reasonable to expect that Australia will come out of this a lot sooner than other countries. But whilst there is that uncertainty, that market volatility will continue. And whether it's a V shape or a U shape recovery, who really knows? But it's markets, as we've seen in April, they probably expect a V shape recovery. But I think it's a more realistic thing to expect a U shape recovery in terms of after we come out of COVID-19. So Robin talked earlier about the toilet paper phenomenon, and I've got this little slide here, and it's as Robin also talked about, it happens everywhere. There is lots of irrational behaviour at the moment. In terms of investment markets, we saw share markets around the world fall significantly in March, and they've rebounded significantly, not all the way, but a good chunk in April as well. Currency markets haven't been spared. We've seen the Australian dollar versus the US dollar go from 0.65 cents or 65 cents to 55 cents, and it's bounced all the way back to 64 cents. The next couple of charts just show you the magnitude of some of the more interesting days in the last 6 or 8 weeks in terms of market movements. And this chart that I've got on the screen right now, this was Friday the 13th here in Australia. And if you go to the very left of that chart, that's about 10 o'clock in the morning, and the market fell around 8%. And it held that sort of range, as you can see, until about 2:30 in the afternoon. But then it went up by more than 12% to close on that particular day at 4.42%. And that spike that you saw from sort of 2 o'clock in the afternoon onwards, that's basically in an hour and a half, with the market going up, a little over 12, or actually about 13%, to get back from -8 to 4.4. So that's the sort of chart you would expect to see in a whole year, let alone one day. And it was a very similar story in the US on the same day. The times that you see at the bottom, they're our times, but you can, the very far left is around 10 o'clock in the morning, local time in the US, and then 7 on the far right is around 4 p.m. their time. But you can see that the market fell until about, on this chart, to about 2:30 in the morning our time, and then from there proceeded to generate a positive return of 9.28% for the day. So Robin talked earlier about switching, and we all know that superannuation is a long-term investment. What we're trying to explain here with this chart is we can't predict things like the coronavirus, for example. We can't predict what happens to markets in short terms, but what we can do is invest for the long term and stay invested, and to ride out these troughs and peaks. So this chart has been provided to us by Morningstar, and it provides an example of the period from just prior to the global financial crisis to January 2020. So if you started with $100,000 on the far left in January 2007, and that's represented by the blue line. If you stay invested and you ride through the recession or the GFC in those grey bars, and you hold it all the way through to January 2020, you'd end up with $299,780. Now, if you, on the other hand, right at the bottom of the market, decide, okay, I'm going to take my money out of the market, I'm going to put it back into the market after a year, well, in that case, you end up with only $195,000. And then finally, if you do take your money out at the bottom, and then you invest it back into cash, as represented by the green line at the bottom, you actually end up with only $57,000. So what that's telling us is that, by keeping your money in, you get to harness the magic of compounding, and by being a long-term investor. If you take your money out of the market and leave it out for a year, you end up with less. And then, to Robin's point earlier about crystallizing your losses, that's what the green line represents. Taking money out at the bottom, and you lock in those losses right at the bottom of the market, and you don't give yourself the opportunity to to make back the money that you've lost. In terms of Energy Super and our investment options, had a pretty good month in April, as you can see. All the investment options generated a positive return, and that's in line with what we saw in share markets. So if you have a look to the right of this page, it talks about the ASX 200 being the Australian share market, up almost 9%. MSCI World is a basket of shares from around the world. That was up 3.6%. MSCI Emerging Markets is a basket of securities of countries which are like China, Brazil, India, and those more developing countries. It returned 9%. And then the US stock market, as represented by the S&P 500, was up 12.7%. And that reflects all those big names that you hear about in the press that are generally beneficiaries of this this coronavirus pandemic. And I'll talk a little bit more about that later. And then in terms of the bond markets, Australian bonds were down slightly, and then global bonds were up 1.5% for the month. But you can see that the returns for April were fairly good after a pretty rough month in March. Now this slide, what we're trying to tell you here is that it talks about being invested for the long term. And this is what you would have experienced as a member, an Energy Super member over the last 15 years. And just to talk through it, the orange bars that you can see, they're the returns that you would have received in each financial year. So, going back to 2005, 2006, you had a couple of pretty good years for the 2 years before the GFC, a couple of pretty rough years between 2007 and 2009. And then thereafter, they've been pretty much all positive with the exception of the current year, which is at minus 4.7, and that's to 30 April. But the key thing to remember is that the objective is 5.5% for the balanced option, which is inflation plus 3%. So, and we're making the assumption here that inflation's 2.5%. Now, during that period, that whole 15-year period, the Energy Super balanced option has returned 9.6%, even with those negative returns that you see in those three bars underneath that are negative. So it just shows if you stay invested through the whole time and you ride out those peaks and troughs, you generally end up through the magic of compounding with returns that are commensurate with the amount of risk you're taking. This is another chart which my colleague David's come up with, and what this chart's trying to tell us is that this is what we've seen from Energy Super's balanced option since the 1st of January 2019. So if you look to the very left, the dark blue bar, you've started out with $10,000, and then over these different time periods, you've made or lost some money. But the key thing to remember is that even with the share markets going up and down, and the return series going up and down, you're still ending up, as at 30 April, with a slightly positive balance. And again, whilst it's only a short time period, and it just shows that by staying invested and harnessing the magic of compounding and staying with the market, you can ride through some of the noise of the negative markets, even with the negative returns that we've seen in March. So in terms of what's done well in our portfolios on your behalf as members, these are all things that you'd expect to have done well. So things that are beneficiaries from the work, shop, play and learn from home. And it's things like Netflix and Amazon and Alibaba, and obviously Zoom, which is the platform that we're speaking on now and meeting on now, Microsoft, and then other things, coming back to toilet paper again, Coles and Woolworths have done really well. Data centers, which are the backbones which support the internet and the data that is being stored there. And then obviously healthcare related companies and providers of personal protection equipment such as 3M. And then lastly here, Regeneron Pharmaceuticals, who are currently also working on a vaccine. So what are we doing in terms of our investment portfolios at the moment. So just as a reminder, we're obviously an industry fund and we're run solely for you as our members. And this extends to everything that we offer, and that includes investments, insurance, and our member services, including the contact center and advice, and people like Steve, obviously, who you can get in contact with. The thing to keep in mind, though, is that this may look very different to what other funds offer their members, and that includes investments. So one question that we've been asked a lot recently is around, how liquid is Energy Super, and can we meet all of our obligations? So, for example, can we meet members' pension payments, and can we meet, the payments needed for the early release of super? Well, I'm pleased to say that we can. We've got plenty of cash in the portfolio, and this slide's actually a little out of date. We've got around $380 million in cash that we can use to, meet all of our obligations, including the early release of super. The other piece of good news is that we haven't been a forced seller of assets. So we haven't had to go and sell shares or bonds or anything else to meet any liquidity needs. We're actually in a really good position at the moment, and we've got plenty of cash to purchase cheap assets as a result of the recent market dislocations. And for those members who have been with Energy Super for a fairly long time, this is very similar to that period between 2009 and 2012, where Energy Super did some great investing during that time, and that benefited the fund probably through to 2017, 2018 with great performance. This is a very similar scenario where we're poised and we're ready to, with cash, to take advantage of investment opportunities as they arise. I talked earlier about not being able to predict short-term market movements or things like the coronavirus, but what we do is we do manage the investment portfolios for the long term. And then in terms of the diversified investment options, and I'm talking about investment options like growth and My Super and balanced and so on, these investment options do have a level of protection, and that's by not just owning shares, but we also have some cash, bonds, property, infrastructure, and alternatives. But what that does mean is that we will lag share markets when they go up, but it also means we won't fall as much as markets as they did in March. And we should be able to smooth out the returns that we deliver to our members. We're spending a lot of time reviewing our existing investments. I've talked a little bit about liquidity. We're also spending time making sure that we've got the right amount of foreign currency. And again, we're looking at markets closely and trying to find, we're turning over stones basically to see what sort of opportunities are out there for Energy Super. More specifically, in terms of those opportunities, in the short term, we think there's opportunities in credit, and what that is that there's loans out there that can possibly be made to corporate entities. We think that they'll need some of that credit for restructuring or to make sure that they can be going concerns. We think that's a great opportunity. In terms of property, infrastructure, and private equity, there'll be opportunities in all of these areas just because of the fact, again, there's going to be businesses out there which will need investment capital to either grow or to even survive. And we think we can pick up assets much cheaper than we would have been able to previously. In terms of risks that are out there, the foreign currency is a risk. It can be both positive and negative. We need to make sure that we have an appropriate amount of foreign currency, and in particular going forward, having foreign currency if the Australian dollar falls is a benefit, and we want that protection for our investment portfolios. And lastly, value traps. What they are things that look cheap, but they're actually cheap for a reason, and they're probably not great investments. So we're spending a lot of time making sure that what we're looking at aren't value traps. So then, in terms of to sum it all up, this is very different, and it's it's not too dissimilar to what we saw with the earthquakes in Japan, but also probably 9/11 was the other thing. But those events were much shorter, and they didn't involve shutting down economies. But they were certainly similar shocks in terms of being something that couldn't be predicted. In terms of the stimulus that I've talked about, both on a monetary and fiscal policy side, they're very large, and fortunately, in an Australian context, but also a Western Australian government context, there's still some bullets left if they need to be fired to continue to support the economy. In terms of that stimulus, the good thing about the stimulus is that not only will it support the economies, but it will also support investments in risk assets. Once we get past this phase of the shutdown of the economies, we expect that that stimulus will also help investments in areas, as I was talking about earlier, so infrastructure and property and so on. Those investments, obviously create jobs, and in turn will generate some returns as well. And then lastly, I talked a little bit about liquidity. Again, it's very sound, and we've got plenty of it so that we can take advantage of investment opportunities. And Claire, it's probably that's the end of my presentation. So I'm happy to take some questions, as I'm sure is Robin.
Thanks for that, Kevin, and thanks for your session too, Robin. It's always hard to know at the end of a webinar exactly what people are thinking and whether they have any questions. And I know that from past experience, people are often a little bit hesitant to ask questions in this sort of forum. The one good thing is that this session has been recorded. I know Claire's been recording this in the background, and I know that it will be available to access in the future through the NECA WA website. So if yourself or your family or colleagues have any interest in going back and reviewing some of the information contained in the session, please feel free to do so. And I guess just tagging on that, myself as a resource in Perth, I'm available to help people. My office is actually at the NECA headquarters in Balcatta. I travel wide and far. I keep my distance during these times, but I'm more than happy to help people out. If you do have questions, either yourself personally or through your business or at the employer site. Before I go, if there's anyone out there who is interested, we are running another webinar along a similar vein this Thursday, the 7th. This one has centered on COVID-19 and super and the impact. The one on Thursday will cover off COVID-19 and the impact in regards to insurance. Quite a topical item at the moment. There have been changes both at a federal level, and Energy Super is making some changes to its insurance coming up as well. So for those that are interested, I invite you to log in and have a listen to that session. If there's no more questions, I'll just wait a couple of seconds in case anyone has summed up some courage. Okay, it sounds pretty quiet out there. I'll let things go. It's a time of night when people are busy, either leaving work, getting home. It can be quite busy, so we'll leave it there. Thank you, Kevin and Robin, for your time this afternoon. And thank you, Claire and the NECA crowd, for organising this session. And for everyone listening, thank you for your time as well. Until then, have a good evening and stay safe. Bye-bye.
Thank you.
Thank you.
Kevin. Thanks, Robin.
Bye-bye.